Hey everyone, welcome to another deep dive. Today we're going to get into the head of one of the most successful investors of all time, Warren Buffett.
A fascinating figure, and someone whose approach has a lot to teach us, even if we're not all aiming to be billionaire investors, right?
Absolutely. And to help us navigate this deep dive, we'll be drawing wisdom from Robert T. Hagstrom's book, The Warren Buffett Way, just excerpts for today's session.
A great choice. It really delves into the core principles that have shaped Buffett's investment philosophy, and it's packed with real-world examples.
Right, so we're not just talking theory here, but how these ideas actually play out in practice.
Exactly, and I think one of the things that jumps out right away about Buffett is his contrarian nature.
You mean that whole be fearful when others are greedy and greedy when others are fearful thing, right?
Exactly. It's more than just a catchy saying. It's a fundamental part of how he approaches the market. Hagstrom even quotes Buffett as saying that he prefers high-yield bonds when they're considered weeds rather than flowers.
Interesting analogy. So it's about spotting those undervalued opportunities that most people are overlooking, right?
Right, and having the conviction to go against the grain, Buffett doesn't shy away from making big bets when he sees something truly compelling. He even uses the term de-worstification, meaning she'd rather concentrate his investments in his best ideas than spread himself too thin.
Hmm. So a focus on quality over quantity makes sense. And this ties into another point Hagstrom makes about the importance of not being afraid to be wrong or to face criticism.
Absolutely. If you're constantly worried about making mistakes or what others might think, you're likely to miss out on those big wins that come from taking calculated risks.
I see. So it's not just about being smart, it's about having the courage to act on your convictions.
Right, and that's where Buffett's unique position with Berkshire Hathaway comes in. Hagstrom points out that unlike typical fund managers who might be forced to sell during downturns because of client withdrawals, Berkshire has permanent capital.
Oh, that makes a huge difference, doesn't it? It gives him the freedom to be patient and to ride out those market fluctuations.
Exactly. He can take a truly long-term perspective without the pressure of short-term performance, which is a huge advantage.
Makes you wonder if that's part of why he's been so successful for so long.
Definitely. But it's not just about having capital. It's about how you use it. And Buffett is known for his constant learning and adaptation.
You mean how he's always reading and researching and staying ahead of the curve?
Right. Hegstrom gives some great examples, like how, even though he was terrified of public speaking early in his career, he took a Dale Carnegie course to overcome that fear.
Wow, that takes guts. Imagine Warren Buffett with stage fright.
I know. And later in life, in his 60s, he even learned to use a computer just so he could play bridge online.
Really? So he's not afraid to try new things, even if they're outside of his comfort zone.
Exactly. And I think that's a great lesson for all of us, whether it's learning a new skill or exploring a new industry. Being open to new experiences and knowledge can really pay off.
For sure. Now, speaking of learning and influences, we can't talk about Buffett without mentioning Benjamin Graham.
Absolutely. Graham is considered the father of value investing, and his influence on Buffett is undeniable. Hagstrom really emphasizes this, especially through the lens of Legg Mason's commitment to Graham and Dodd's principles.
Can you remind us what those key principles are?
Of course, it's all about finding those undervalued stocks, looking at metrics like low price to earnings ratios, low price to book ratios, high dividend yields, that kind of thing.
So looking for those hidden gems that the market might be mispricing.
Exactly. And Hagstrom even shares an anecdote about a participant in an investment training program who understood the logic of Graham's approach, but still felt like something was missing.
Interesting. So maybe there's more to it than just crunching the numbers.
That's where Buffett's direct experience with Graham comes in. He actually took Graham's class at Columbia and aced it, earning the first A+ Graham had given out in 22 years.
Wow, they must have really clicked.
They did. Hagstrom describes their connection as having instantaneous chemistry. And even though Buffett was initially rejected for a job at Graham Newman, he kept sending Graham investment ideas and eventually landed the position in 1954.
Persistence pays off. So how did Graham shape Buffett's view of the market?
Hagstrom quotes Roger Lowenstein, who said that Graham provided the first reliable map to the stock market, transforming it from a seemingly random game of chance into a disciplined approach based on logic and analysis.
I like that analogy. It's like he gave him the tools to navigate this complex world.
Exactly. Alice Schroeder even compares it to Buffett emerging from a cave and seeing stocks not just as fluctuating prices, but as representations of actual businesses with underlying value.
That's a powerful image.
Right.
So what were some of the core principles that Graham instilled in Buffett?
Two key ones were ensuring the safety of principal, meaning protecting your initial investment and aiming for a satisfactory rate of return.
Sounds like pretty solid advice.
It is. And to achieve that safety, Graham developed the concept of margin of safety, which
Hmm.
essentially means buying stocks below their intrinsic value, giving you a cushion in case your calculations are off.
Makes sense. So you're not just buying something because it's cheap, you're buying it because you believe it's worth significantly more than what you're paying for it.
Exactly. And Graham was a big proponent of focusing on quantitative data, balance sheets, income statements, that kind of thing. While he acknowledged the importance of qualitative factors like management, he was wary of relying too heavily on them because they can be subjective.
So sticking to the hard numbers as much as possible.
Right, because those numbers provide a more objective measure of a company's worth. Now, Graham's investment strategy often led him to those deeply unpopular stocks, the ones that everyone else was avoiding.
So going against the crowd again.
Exactly. He believed that the market often overreacts to both good and bad news, creating opportunities for those who can see through the hype and fear.
So Graham was all about finding those diamonds in the rough.
Precisely. But while Graham provided that foundation in value investing, Buffett also drew inspiration from another influential figure, Philip Fisher.
Right. Fisher had a slightly different perspective, focusing more on growth and the quality of management.
Exactly. Fisher was interested in those companies that could consistently grow their sales and profits at rates above the industry average. He looked for companies that were either fortunate and able, meaning they were in a growing market and had the skills to capitalize, or fortunate because they are able, like DuPont, which used its existing knowledge to create entirely new and profitable markets.
So he was looking for companies that could not just survive, but thrive in the long run.
Exactly. And Fisher's method for gathering information was also quite unique. He called it the scuttlebutt approach.
What's that?
It involved going beyond the financial statements and talking to people who actually knew the company well, customers, suppliers, competitors, to get a more holistic view of the business.
So getting the inside scoop from those on the ground.
Right. It was about tapping into that informal information network to gain a deeper understanding.
Interesting. So we've got Graham emphasizing value, Fisher highlighting growth and management, and then enters Charlie Munger, who really completes the picture for Buffett.
Their relationship, as Hagstrom describes it, is incredibly close, almost symbiotic. Munger really challenged Buffett to think beyond the purely quantitative approach that Graham championed.
And the acquisition of See's Candies is a great example of that shift, right?
Exactly.
Mhm.
Buffett was initially hesitant because the price seemed high by Graham's standards. But Munger convinced him that paying a premium for a truly exceptional business with a strong brand and loyal customer base was a smart move.
So quality over a bargain basement price.
Right, and it turned out to be a brilliant decision. See's Candies became a cash cow for Berkshire, and Buffett even turned down an offer to sell it for 5 times the purchase price just a decade later.
Wow, talk about a return on investment.
Ugh.
So this marked a turning point for Buffett, wasn't it?
Hagstrom argues that it was the first time Buffett truly embraced the idea of paying for quality. He was evolving beyond those strict Grahamian principles.
And there's that great quote from Keynes that Hagstrom includes, right? The difficulty lies not in the new ideas, but in escaping from the old ones.
Exactly. It's often harder to unlearn something that's worked for you in the past than it is to learn something new.
Makes sense. So while Buffett still believes in the importance of a margin of safety, his overall approach has become more nuanced.
Right. He now places much greater emphasis on understanding the underlying business and assessing the quality of management, something that Graham didn't focus on as much.
So it's like he's taken the best from both Graham and Fisher and blended them together.
Precisely. And Hagstrom sees Munger as the embodiment of that synthesis, bringing in Fisher's focus on qualitative factors while also keeping Graham's emphasis on the psychology of investing, or as Munger calls it, the psychology of human misjudgment.
So bringing all these influences together, what are the key tenets of the Warren Buffett way as Hagstrom lays them out?
Well, he breaks them down into 3 categories: business tenets, management tenets, and financial tenets.
Okay, let's start with business tenets. What does Buffett look for in a business?
First and foremost, he wants businesses that are simple and understandable ones that he can easily grasp. He's not interested in overly complex industries or companies with convoluted business models.
So no fancy jargon or complicated financial engineering.
Right. He wants to be able to clearly understand how a business makes money, and he also looks for companies with a consistent operating history. He wants to see a track record of solid performance over time.
So no flash-in-the-pan companies or those with a history of ups and downs.
Exactly. He wants to see stability and predictability. And finally, he's looking for businesses with favorable long-term prospects, those that have the potential to grow and compound their earnings over many years, what he calls economic franchises.
And what defines an economic franchise?
It's a business that offers a product or service that is needed or desired, has no close substitute, and isn't subject to heavy government regulation.
So it's something like Coca-Cola or Gillette.
Exactly. Those are classic examples.
Yeah.
These companies have strong brands, pricing power, and a durable competitive advantage.
And Buffett also stresses the importance of staying within your circle of competence, right?
Absolutely. That means investing in industries and businesses that you understand you're not going to be successful, trying to pick winners in fields you know nothing about.
Stick to what you know, basically.
Exactly. All right, let's move on to management tenets. What does Buffett look for in a management team? 3 key things: rational decision-making, candid communication with shareholders, and a resistance to what he calls the institutional imperative.
Okay, break those down for me.
Rationality is crucial, particularly when it comes to allocating capital. Buffett believes that this is the most important job of management, and he wants to see leaders who make smart, disciplined decisions about how to invest the company's money.
So no empire building or chasing after the latest fads.
Right. It's about making those long-term value-creating decisions. And he also values transparency. He wants managers who are honest and upfront with shareholders about the company's performance and challenges.
So no sugarcoating or hiding bad news.
Exactly. And finally, he wants leaders who can resist the institutional imperative.
Yes.
It's the tendency for managers to simply follow the crowd, to do what everyone else is doing, even if it doesn't make sense for their own company.
So kind of like a herd mentality in the corporate world.
Right. Buffett sees this as a major cause of poor capital allocation. He says it leads to a lust for activity, this constant need to be doing deals and acquisitions even if they don't add value. And it can also lead to overpaying for assets just to keep up with the Joneses.
So it's about thinking independently and not being afraid to go against the grain.
Exactly. Now, finally, let's talk about financial tenets.
This is where we really see the numbers come into play, right?
It is, but it's not just about looking at any numbers. It's about focusing on the right ones. Buffett prioritizes return on equity over earnings per share. He wants to see how efficiently a company is using its capital to generate profits. He also calculates what he calls owner earnings.
What are owner earnings exactly?
Yeah. It's a way of looking at a company's true cash flow by taking into account depreciation, amortization, and capital expenditures.
So it's a more realistic measure of profitability.
Exactly. And Buffett also looks for companies with consistently high profit margins. He wants to see that a company can generate healthy profits on its sales. And he wants to make sure that every dollar of earnings retained by the company creates at least $1 of market value over time.
So essentially, he's looking for companies that can grow their intrinsic value at a rate equal to or greater than their earnings growth.
Precisely. And he's generally wary of companies that rely heavily on debt to boost their returns. He prefers companies with strong balance sheets and low debt levels.
So those are the core tenets of the Warren Buffett way.
Yeah.
But how do they actually play out in real-world investment decisions? Hagstrom provides several case studies.
Yeah, let's touch on a few key ones to see how these principles come to life, starting with the Washington Post.
The newspaper business.
Yeah.
Not exactly known for its growth potential these days.
True, but Buffett saw something different. He understood the fundamental economics of the business. He recognized the power of the Washington Post's brand and its unique position in the market. He saw a significant margin of safety in the price he paid, and he believed that the company could improve its profitability under Katharine Graham's leadership.
So he wasn't just buying a newspaper, he was investing in a well-run business with a strong competitive advantage.
Exactly, and Katharine Graham proved to be an excellent capital allocator, using share repurchases to increase the value of the remaining shares, what Buffett calls the $1 premise. If you can buy back shares at a discount to intrinsic value, you're creating value for the remaining shareholders.
Clever. Now, what about Geico? That one seems like an outlier because it was undergoing a turnaround when Buffett invested.
Right, but what was crucial there was that Buffett recognized that the core business model of providing low-cost direct-to-consumer insurance was still fundamentally sound. He saw a sustainable cost advantage. He liked the management's transparency about the challenges, and he identified a significant margin of safety, even though the company was facing headwinds.
So he wasn't afraid to invest in a company that was going through a rough patch,
Yeah,
as long as he believed in the long-term potential.
exactly. And Geico turned out to be a huge winner for Berkshire.
Now, Capital Cities ABC is an interesting case because Hagstrom says that Buffett was willing to compromise on his margin of safety requirements because he was so impressed with the management team of Tom Murphy and Dan Burke.
Exactly. Buffett places a very high value on finding exceptional managers, and in this case, he was willing to pay up a bit because he had so much confidence in their ability to allocate capital effectively and grow the business.
So it's not always just about getting the lowest price. Sometimes it's about betting on the right people.
Absolutely. And then there's Coca-Cola, a classic Buffett investment that perfectly illustrates his focus on strong brands and enduring competitive advantages.
Ah, the power of economic goodwill.
Precisely. Buffett recognized the strength of Coca-Cola's global brand, its incredible distribution network, and its ability to consistently grow its earnings. He also saw the positive changes under Roberto Goizueta's leadership, and he valued the company based on its projected future earnings power.
So he was looking beyond the current stock price and focusing on the long-term potential.
Exactly. And he bought a lot of Coke stocks. It became one of Berkshire's largest holdings.
What about the other case studies Hagstrom mentions? General Dynamics, Wells Fargo, American Express, IBM, H.J. Heinz.
Each one highlights a different aspect of Buffett's approach. General Dynamics is about focusing on businesses with franchise-like characteristics and rationalizing operations to improve efficiency. Wells Fargo showcases Buffett's deep understanding of the banking industry, and his ability to assess risk. American Express demonstrates the power of a strong brand and a positive change in management. IBM highlights Buffett's appreciation for financial acumen and his willingness to be patient with his investments. And H.J. Heinz fits his criteria of a company with a consistent operating history and favorable long-term prospects.
So each investment is unique, but they all share those common threads of value, quality management, and long-term potential.
Right. And this brings us to another fascinating aspect of Buffett's strategy-focused investing.
You mean the idea of concentrating your investments in a smaller number of high-conviction ideas rather than spreading them thinly across many different companies?
Exactly. It's the opposite of diversification, which is what many financial advisors recommend.
So why does Buffett prefer to focus?
He and Munger believe that if you have a significant edge and the odds are in your favor, it makes sense to bet big. They even draw parallels to the Kelly optimization model, which is a mathematical approach to determining the optimal size of a bet.
So it's about maximizing your returns when you have a high degree of confidence.
Right. Munger famously said that owning just a few outstanding companies is enough if you truly understand them and can handle the price fluctuations.
But isn't that risky, putting all your eggs in one basket, so to speak?
It can be, but the key is to make sure you're betting on the right horses and that you're not overbetting. Munger uses the analogy of waiting patiently at the racetrack for those good horses with inviting odds.
So being selective and disciplined.
Exactly. And Hagstrom provides examples of other successful focused investors like John Maynard Keynes and the Sequoia Fund, both of whom achieved impressive long-term returns with concentrated portfolios.
But he also points out that focus investing can lead to periods of underperformance, right?
Right. It's not a smooth ride. There will be times when your concentrated bets don't work out as expected. But the idea is that over the long run, the winners will more than make up for the losers.
So it's a strategy that requires patience and conviction.
Definitely. Now, this all raises an interesting question. How does Buffett truly measure the worth of an investment?
Yeah, clearly it's not just about the daily fluctuations of the stock price.
Right. Buffett famously believes that the market is often irrational, driven by fear and greed. He focuses on the intrinsic value of the underlying business rather than being swayed by short-term noise.
So he's looking for those companies that are worth more than their current market price.
Exactly. And he's willing to wait for the market to recognize that value, even if it takes years.
That takes a lot of patience, especially when you see other stocks soaring while yours are lagging behind.
It does, but it's essential for long-term success. Hagstrom introduces the concept of look-through earnings as Buffett's preferred metric for judging performance. It's a way of looking at the earnings of the companies Berkshire owns as if they were all flowing directly into Berkshire's coffers.
So it's like taking a consolidated view of the entire portfolio.
Right. It's a way of measuring the true earning power of Berkshire's investments over the long term. Now, finally, we need to talk about the psychology of investing.
This is a topic that's often overlooked, but it's crucial for understanding Buffett's success.
Absolutely. Our emotions can play a huge role in our investment decisions and often lead us to make irrational choices.
Like selling in a panic when the market drops or chasing after hot stocks that have already gone up significantly.
Exactly. Hagstrom discusses several key biases that can trip us up, like overreaction bias, loss aversion, mental accounting, and myopic loss aversion.
Can you explain those briefly?
Overreaction bias is the tendency to overreact to both good and bad news. Loss aversion is the fact that the pain of a loss feels more intense than the pleasure of an equivalent gain. Mental accounting is the way we tend to categorize our money differently, which can lead to irrational spending and investment decisions. And myopic loss aversion is the combination of loss aversion and frequent portfolio evaluation, which can lead to short-term anxiety and poor long-term decisions.
So basically, we're wired to make emotional decisions that are often not in our best interests.
Right. And Buffett is a master at overcoming these biases. He stays focused on the long term, he doesn't get caught up in the hype or the fear, and he makes rational decisions based on his analysis of the underlying businesses.
He's the epitome of that cool, calm, collected investor.
Exactly, and that's a big part of his success. Now, Hagstrom contrasts Buffett's approach with modern portfolio theory, which emphasizes diversification and minimizing volatility, and the efficient market theory, which suggests that stock prices always reflect all available information.
Buffett clearly doesn't subscribe to those theories.
No, he believes that the market is often inefficient and that opportunities exist for those who can identify mispriced assets.
And the fact that a psychologist, Daniel Kahneman, won a Nobel Prize in economics for his work on behavioral finance really underscores the importance of understanding these psychological factors.
It does. It shows that our emotions play a much bigger role in financial decision-making than traditional economic theory would suggest.
So how does Buffett manage to stay so rational in such an emotional environment?
Hagstrom argues that it's partly due to his personality. He's naturally inclined towards patience and discipline, but it's also due to his conscious effort to cultivate those qualities. He's developed a set of mental models and habits that help him to avoid making those impulsive emotional decisions.
So it's not just about being smart, it's about having the right temperament and the right mental tools.
Exactly. And this brings us to the final point Hagstrom makes about Buffett's success. His ability to not just survive, but thrive during challenging times.
You mean like the 2008 financial crisis or the dot-com bubble?
Exactly. Buffett is known for his ability to stay calm and rational during times of market turmoil and to use those opportunities to buy great businesses at bargain prices.
That's when those cash reserves really come in handy.
They do. Buffett always maintains a significant cash position so that he has the flexibility to act when others are forced to sell.
So what's the key takeaway here? What can we learn from Buffett's approach?
I think the biggest lesson is the importance of thinking long term, of focusing on the fundamentals, of understanding the businesses you invest in, of being patient, and of not letting your emotions rule your decisions.
Those are valuable lessons, whether you're investing in the stock market or in your own life.
Exactly. It's about developing a rational mindset and sticking to your principles even when the market is going crazy.
Sounds like a recipe for success in any field.
It is. So as we wrap up this deep dive into the Warren Buffett way, I want to leave you with one final thought.
Go ahead.
Given Buffett's emphasis on long-term thinking, what is one area of your own life where adopting a more patient and less reactive approach might yield the most significant benefits down the road?
That's a great question. It's definitely something to ponder.
It is, because in a world that's increasingly focused on instant gratification and short-term results, the ability to think long-term, to delay gratification, to make those difficult but necessary choices that will pay off in the future, that's a truly valuable skill.
Couldn't agree more. Thanks for joining us for this deep dive into the wisdom of Warren Buffett and for sharing your insights.
This is my pleasure.
We hope you found it valuable and that it's given you some food for thought as you navigate your own investment journey and your life in general.
Until next time, happy investing.
And remember, stay curious, stay informed, and stay ahead of the curve. Hey everyone, welcome to another deep dive. Today we're going to get into the head of one of the most successful investors of all time, Warren Buffett.
A fascinating figure, and someone whose approach has a lot to teach us, even if we're not all aiming to be billionaire investors, right?
Absolutely. And to help us navigate this deep dive, we'll be drawing wisdom from Robert T. Hagstrom's book, The Warren Buffett Way, just excerpts for today's session.
A great choice. It really delves into the core principles that have shaped Buffett's investment philosophy, and it's packed with real-world examples.
Right, so we're not just talking theory here, but how these ideas actually play out in practice.
Exactly, and I think one of the things that jumps out right away about Buffett is his contrarian nature.
You mean that whole be fearful when others are greedy and greedy when others are fearful thing, right?
Exactly. It's more than just a catchy saying. It's a fundamental part of how he approaches the market. Hagstrom even quotes Buffett as saying that he prefers high-yield bonds when they're considered weeds rather than flowers.
Interesting analogy. So it's about spotting those undervalued opportunities that most people are overlooking, right?
Right, and having the conviction to go against the grain. Buffett doesn't shy away from making big bets when he sees something truly compelling. He even uses the term de-worstification, meaning she'd rather concentrate his investments in his best ideas than spread himself too thin.
Hmm. So a focus on quality over quantity makes sense. And this ties into another point Hagstrom makes about the importance of not being afraid to be wrong or to face criticism.
Absolutely. If you're constantly worried about making mistakes or what others might think, you're likely to miss out on those big wins that come from taking calculated risks.
I see. So it's not just about being smart, it's about having the courage to act on your convictions.
Right, and that's where Buffett's unique position with Berkshire Hathaway comes in. Hagstrom points out that unlike typical fund managers who might be forced to sell during downturns because of client withdrawals, Berkshire has permanent capital.
Oh, that makes a huge difference, doesn't it? It gives him the freedom to be patient and to ride out those market fluctuations.
Exactly. He can take a truly long-term perspective without the pressure